How to invest during a recession. Guys, I've been investing in real estate since 1999, so almost 24, 25 years here. And I've seen some recessions. As a matter of fact, when I started buying real estate, interest rates were somewhere around 8 or 9%. And it was a recession then when I bought my first piece of real estate. The very first piece of real estate I bought was a duplex. And the duplex I bought off the MLS and I paid full retail price for it. I thought that I was getting a good deal, but the reality is I really wasn't. So what I had to do is I had to create it into a good deal. And I did that by turning the basement into another rental unit. So there's a studio apartment. So then it was a threeplex because this was the layout here. This was this, and there was 2 beds, and then there were stairs that went down, my wonderful drawing. And then there was a little 1 bedroom. So there's a 2-bedroom here, a 2-bedroom here, 2-bed, 1 bath, 2-bed, 1 bath, 1 bed, 1 bath. That was underneath this, my beautiful drawing. So I did that, which increased the rent. Now, I did that because I moved into this property, and these two basically paid the majority of my living expenses was spent. I lived here for free, or close to free. And then what I could do is I could save that money that I was paying in rent, and I could save up that money so that I could then take that to put that as a down payment onto another property. Now, the great thing now is there's new loans called DSCR loans because they will take and do the loan based upon your rents, not based upon your personal income, because to get this property, I had to qualify for it. I had to have the income to qualify for this property, where with DSCRs, you do not have to have the income to qualify for it. So that's massive. You're also limited by how many properties. The idea of getting into real estate now versus 25 years ago, it is so much easier to get into real estate now. There's so much more available to have success in it. So that was my first deal. I don't know what I paid for it. I'd have to dig a lot to find that, and I still maybe wouldn't. But we ended up selling that property a few years later. I would say 4 or 5 years later. The reason I sold it, and I'm not a fan of selling real estate, but I changed my model and I went away from plexes and I went just to single family houses. And the reason why I went to single family houses is because my average tenant right now stays for 5 years. My average tenant here stayed for 6 months. So these are what I call transient tenants. The most expensive thing you have with your rental properties is your rent ready. I've got to clean the carpets, maybe have to do a recoat of paint, whatever the case is. The rent ready is very expensive. The loss of rents is also very expensive. And so I came up with a new strategy because these, when I ended up with a 4-bedroom, 2-bath house, there was less transient. People that went there wanted to stay there longer, where these things were more changing all the time. Now, there's different models for different things. I really like this model because I wanted to have low management, and this model works really well for that. So depending upon what you're looking to do. So that was my first deal. I paid full retail value for it. I didn't get a great deal. And so that was my very first rental property. Interest rates were around 8.5%, somewhere in there. And so it was a good time to buy during that kind of a recession. And the reason is because prices were lower. Typically what you have when you're dealing with a recession is you typically have lower prices and higher interest rates. Now, there's a few different types of recessions, right? It could be real estate, it could be tech sector, it could be a bunch of different sectors, it could be the stock market. So it depends on what type of recession we're talking about here. But typically, if it's a real estate type recession, you'll have lower prices when interest rates are high. So we're starting to see interest rates starting to come down, which typically will make prices rise because your cost, people are buying houses based upon their payment. Can I afford the payment? And based upon that could have an increase on prices, or typically does. 2008, 2009, okay. What happened? It was the real estate bubble, the biggest real estate correction of all time. And so there was a house that I looked at during this time. The house had sold 5 years earlier. So let's just say it was a brand new construction house that had sold. It sold, I don't know, let's just say 2002. And it sold for $958,000, really close to $1 million, okay? This, a few years later, 5, 6 years later, this house was listed on the multiple listing service, and it was listed for somewhere around, I don't know, 400,000. So it was less than half the price. We went and got this property under contract for somewhere around $350,000. And again, this is in 2009-ish. And I remember fretting and stewing about if we were paying too much for this property at $350,000. And the reality is, I think in the current market situation, I probably was paying a little too much for it. But I went and did it anyway. Really, my wife talked me into doing it, or I wouldn't have. Fast forward, and in 2021, 22, somewhere in there, I sold that property for about $1.2 million. Now, we had put some money into it and some of those things, but still, it's a significant gain. And I think that's when you're talking about real estate, there's different types of plays. You've got your transactional, where you buy it and you sell it. Maybe you fix it up, which would be a flip. Maybe you get it under contract and sell your contract, which would be a wholesale, or you're buying it and holding on to it. No matter what type of real estate you're doing, if you want long-term wealth, you've got to invest long-term in real estate. That's really what it comes down to, is investing in long-term real estate. So let me show you, because this is the best way I can feel comfortable with what's going to happen in the future, is to look at the past. I look in the past and say, okay, what happened? So if we look here in 2007, that was the peak. This is median house prices. At 2007, that was the peak at $257,000. Okay, let's actually write that down. So 257. Okay, the worst of it, this was in Q1 2007, okay? Or, let's make sure I've got it right. Yeah, 2007, okay? Then the worst of it, it's kind of funny because it came down, it popped up a little bit, but the very worst of it was in 2009. 2 years later, it was at $208,000. Now, this is really important because I want you to remember these numbers. Then, to get back to the 257, we got back to the 257. So we got back to, say, 258 in Q1 of 2013. Okay, so now let's jump back over to the whiteboard here and really diagnose this, okay? So the high of the market, 257,000 in 2007. This is the high. The low of the market, the lowest it went was in 2009. That's 2 years later. And it went to $208,000, okay? So the difference between that's what's $49,000. $49,000 divided by 208. 23, actually it's 257, subtract 208, divided by 257 is a 19%. Values went down 19%. Okay, so if you look at the very worst market correction, real estate market correction of all time, okay, it was a 19% difference in what happened in the values. However, a few years later, in 2013, let's see, what are we going to call that 4 years later? So from the lowest to back up to where it was 4 years, okay? And that's when we got up to $258,000. So there's a couple of things to learn from this. One, the lowest to back to where it was a 4-year period. So do you have the staying power where you could hold this property for 4 years? that's important, okay? And we'll talk about more of that in a minute. The other thing to keep in mind is the value of the property dropped 19%. We'll just call it 20%. So if you play your cards right, your worst case scenario, based upon historical performance, is a 20% decline in values. And your worst case scenario is you're holding that property for 4 years. That's our worst case scenario. However, what are we doing? What are we going to do during that? We're going to rent the property. So if we go look at rents during the same time period, okay, in 2007, rents were approximately, let's just call it $720 for rents. So rents were about $720. Okay, 2 years later in 2009, oh, what happened to rents? They went up. Rents went up, not lowered. Rents went higher. Why is that? People were getting foreclosed. Everybody was moving down. Rents went up. Okay. And then let's look at 2013. Okay. Rents, let's just call it like 923. Rents were up again. So when it comes to investing during a recession, it really comes to playing the long game here. If you know what your worst case scenarios are and you buy something, you plan on keeping it forever, you're going to see a few amazing things happen. One, you will see rents increase. It doesn't matter. Rents will go up over time. It's historically. You can see in 1940, the median rent was $27. In 2021, the rent was $1,191, and it's gone up from there, okay? Rents go up. Second thing you're going to see is values go up, okay? So we come back to our other chart here, which you can find all this on our website. Values go up. Like the same house, the median house, 20,000, and we're at 412 or, thereabouts, which is, we've gone as high as 438. So you're seeing values that'll continue to go up. When you're dealing with a recession and you can buy properties in this area, which is where I bought that house that I was telling you about. Maybe I bought it a little bit on the high side and I'd seen some things lower and I was like, oh no, what if things go in half? And I can tell you, it was just as hard for me to decide to buy that property during that recession as it's going to be for you saying, should I buy this house? Oh no, what's going to happen? And that's where we've got to look back on historical performance and come up with what we think is going to happen in the future. The other thing that happens with this is your tenant is going to pay down your loan. Okay? Tenant is going to pay down your loan. So if you come over here and we look at this stuff. Nope, wrong one. The tenant is going to pay down your loan. Okay? So if you're buying a property for $350,000, let's say, I mean, it could be more, could be less. Let's say taxes, that's about right. We're going to put interest rate at 6.5% because it's an investment property. Not going to put any mortgage insurance. So your payment on that is $23.93. Okay. So now what I want to show you is an amortization schedule. Okay. So $350,000. 30-year, we're going to go 6.5% on the rate. Loan starting date, fine. And here's the schedule, okay? In their first payment, that first year, about $320 is going towards principal and $1,900 is going towards interest. But you can see something. Every single payment, the amount that goes towards interest goes down and the amount that goes towards principal goes up. As a matter of fact, in your final year of payment, the majority of your payment, let's go all the way down here to 30 years. You can see here, the majority of your payment, $23 goes towards interest and $2,188 goes towards principal. Most people don't realize this, that this is how it works. So this is your pay down. So you can see in this year, you're going to pay down what? $25,000. Where in this first year you paid $300 a month, so you got $3,600 that has gone towards interest. So what's important here is, let's just say we're 4 years later Okay, so 2025, 2026, 2027, 2028, so 2029. Okay, so to this point, let's say we're sitting right here. What I owe is $332,000 and I owed $350,000. So my tenants over that 4-year period have paid down $20,000 of my loan. But the other great thing here that people just don't realize is if interest rates go down, I can still refinance. So if I buy something when interest rates are a little higher and they go down, I can refinance. I'm typically buying a better deal when interest rates are higher, and then I can refinance when interest rates go back down. So I can still maintain this asset, have this asset, and then refinance when rates go down. So if I buy this at 6.5% and rates get down to 3%, I can refinance that. Now, yes, I'm going back onto an amortization schedule, and maybe I want to do a 10-year or a 20-year, or maybe I want to do a 30-year and just pay extra. But those are some things that I can do also. So as we're talking about investing in a recession, the most important thing is we invest for the long term, not for the short term.